excited for the first episode of TrueAccord Talks on what is disruption in fintech in 2021, which I feel like part of that's a little bit of a cop-out because we're halfway through 2021 already. So you don't even have to make as many predictions. Like you kind of have like 6 months of stuff to go on already.
I know, but it's kind of a year where nobody really knows what's going on, right? And people change their opinion on a daily basis. So maybe I can still surprise.
There you go. So in your mind, sort of talk us through, what's happened in the first half of the year and how you expect that to evolve in the second half. Because some things that I think of are like, it feels like, especially in the back end of 2020, financial inclusion and all that stuff was really on top of mind. And I'd love to see how that and other themes have sort of played out and how you see that moving forward into the final 6 months of the year.
We're witnessing an experiment that no one has ever, I don't think, experimented before is alive today, which is basically the government giving people a lot of money. And we're seeing how that impacts the market. And I think it's fascinating, right? Because when you look at stimulus payments that are still going on in many states and many locations, the replacement rate to minimum wage is 100% or more. Right, so we're talking about people who don't, and I say this in the most positive way, right? They don't need to work, or they don't need to work in jobs that they used to work in order to make a living, feed themselves and feed their family, and that's fascinating, and that's great. It also changes. So we've seen this resurgence in Robinhood and other trading apps. I think you can think of it as in a negative way. People are bored and they have money and they want to trade, but you can also think of it in a very positive way, in the sense that people have access to cash and they want to use it to gain leverage and to invest in their nest egg for the future. And they've seen a lot of their assets appreciating. I think that's really awesome. We have seen a tremendous drop in debt settlement and payday lending because people don't need those products. It may normalize, but currently that's the case. We've seen a lot more emphasis on affordable financial services like neobanks and earned wage access that are replacing those old products. And hopefully, because people have a little bit more money, the markets are reopening now. People are starting to think about, I'm hearing a lot more people talk about credit repair and credit scores and whether they're good or not. I interpret it as people are starting to care because they're starting to want to borrow, but in a way that's not sustaining, like really helping them build equity and build their life, which is really awesome. So they're starting to bump against what's available to me based on my credit score. So I don't know for sure, but it feels optimistic. It feels like the second half of the year could be about re-leveraging, but in a way that could be a lot healthier than we've seen before.
Which I find fascinating too, because I remember when the stimulus checks, sort of ran out, we knew that there weren't going to be any more because things started opening up again. There was this big question of, is that bad for the economy now? Like, are consumers going to be much worse off now that they don't have these like $1,200, $2,000, whatever it might be, checks coming in from the government, as well as the excess unemployment running out?
Yeah, I think we still, and this is the don't know part of it. We still don't know. If you look at, I think there was a tear sheet chart a week ago about the popularity of different apps on app stores, and you could track the popularity of the loan apps that really plummeted when COVID started and started growing through Q4 of last year, which is something that we've seen at TrueAccord as well. People's ability to play has changed, and then again with the stimulus in Q1 dropped again. But now it's starting to climb. So what does that mean? I don't think any of us knows, but it's obvious that we've witnessed a really incredible cycle. And if we have a chance to really help both, people are talking about the K-shaped recovery, we have a chance to help not only the top arm of the K, but the bottom arm of the K come back to work and be able to borrow to improve their equity, to improve their lives instead of just to feed their family, which is tragic.
Yeah, and you guys have gotten a lot of really interesting data on this too. I remember you came out with a report towards the end of 2021, just looking at how people use their stimulus checks. Do you think that what signals does that give you to the future of the economy and what people are going to put any, excess savings towards? Because I know you mentioned that people have excess capital and they're bored at home, so they were trading. Now that they are going back to work, are they going to put that money towards more robo-advisor type things where it's just sort of set it and forget it? Are they going to focus more on paying down debt? Or of course, are they going to travel a lot more and put it towards vacations and trips that they didn't get to have for a year or two?
Yeah. Well, I, with the caveat that, of course, I'm not an economist, and I don't think the economists know either. We've seen people pay down their debt when stimulus checks came in, which is great. So people have been delivering. We've seen a drop in overall credit card balances. We've seen default rates in Q4 of last year. We've seen default rates at their lowest since, I think, 1985. Something tremendous. And I keep telling our team, we are in this market, we're in debt collection and consumer debt because we want to solve what we perceive to be a structural problem, right? If somebody pressed a button and that problem went away, we'd be like, okay, I mean, I guess that human misery doesn't exist and we don't need to solve it anymore. That would be awesome. I don't think that is a sentiment that everyone shares, in the sense that I think people expect everything to normalize. Consumers prefer, to a large extent, consumption. When people go back to partying, to traveling, to kids go back to school, we're going to see a relevering that some of is not going to be very healthy, and it's going to normalize. And so, yeah, I don't think that's going away anytime soon.
So speaking of that normalization too, how do you, during the pandemic when everyone was stuck at home, the more normal thing to do is obviously check your phone for all your financial information rather than go to a bank or anything like that. How do you see those things normalizing, as well as, in-store shopping versus online shopping, which you personally have a ton of experience in the payment space?
Yeah, I really hope. So when COVID started, there was a chart circulating about how online e-commerce just jumped as percentage of overall e-commerce. I don't think there was it's percentage of overall commerce, rather, and I don't think we've spent a lot of time talking about the denominator, right? I mean, because if everything shrinks and people move to buy from home, of course the percentage is going to be higher. Look, we've seen BNPL become extremely, buy now pay later, become extremely popular. That is continuing. I do believe that is a healthier form of credit compared to credit cards in terms of both APR and how risk can be controlled. I do think that we're seeing a lot more shift to online processes and payments and so on. Even in our small bubble, collections, recoveries, consumer debt, and so on, we're seeing a strong push to digitization that is not driven only by us anymore. Like, everyone wants to do it, but there are definitely, like, how much of it is going to stick when people go out and want to meet people? It's a good question. I don't know, maybe if you have a take on it and your team has a take on it, but it's hard to say. And I can tell you that in the world of consumer debt, there are so many antiquated processes still, where we would try and work with the creditor or with a collection agency, and they would just expect consumers to either call in or send a letter, that it's still an uphill battle to digitize that world. So we're seeing a shift, but the shift is not as dramatic as we thought, I think, when the world closed down for COVID.
Yeah, I was, my husband was at the mall about a week ago and it was just packed here in Austin, Texas. So you can tell that as much as people shop online, and I'm sure they're still going to keep shopping online with Amazon and other retailers that they've become more accustomed to, I think people definitely want to have that face-to-face time. So I'd almost think, and this is just me speculating too, is that we almost like see a massive tick the other way at first, and then it goes back up and stabilizes a little bit as people did get their chance to see other people and kind of like normalizes somewhere in between in that aspect.
Yeah, I wonder, telemedicine, not something that we talk about often. The shift to telemedicine has been incredible. There was a lot of unneeded regulations and certification, at least in the US, that prevented that. It was eased in times of COVID, right? So people get a lot of consultations online. Is that going to stick? Because that's going to be incredible and a boon for healthcare and for consumers. I want to believe that, but as we're humans, we adapt to stuff, right? We change our behavior very quickly. So let's see, we can hope.
What about, so we've talked about all these things that are new. What is new to disruption based on, rather than these things that, they're new-ish, but they've been
Mhm.
around for a few years, for people that are early adopters like you and me that have used challenger banks for a while, and
Right.
we've known what some things like buy now, pay later are for a while, stuff like that.
In the startup ecosystem, we can be very sarcastic or even cynical about new solutions that look like old solutions. And I could tell you, hey, well, what's different about BNPL? It's basically purchase financing, right? And what's different about Ramp and Brex, two powerhouses in merchant banking, or what's different about ClearBank and other companies that offer financing? It's just merchant cash advance. But the reality is that a lot of times a reframing of a solution and a new paradigm that offers almost the same solution but in a different way just clicks with consumers, and then it just changes the conversation completely. So BNPL is one of these things. Neobanks, I mean, it's a bank after all, right? But people are getting paid 2 days in advance, and they're using their debit cards, and they're managing their cash flow, and they have credit building products. And to me, that's incredible. And shows that when you put it in a different form factor, people react to it, and it becomes a meaningful power for disruption. And for me, the same thing is with TrueAccord. Having sold this product and having sold the idea of what we're trying to offer for 7.5 years now, of course, when I started talking to people, they would say, well, you send emails, anyone can send emails, right? And of course, we send emails, we send text messages, we do a bunch of stuff that's part of our solution as a way to reach consumers. But really how we think about this, we think that talking to consumers about that is about thinking like an e-commerce brand. It's about thinking about your relationship. It's about offering a membership club. It's about offering a holistic view of your finances. So yeah, sending emails is part of it, but it's not the whole picture. So again, for us, changing the modality, taking things that work elsewhere and putting them in a new world and seeing how consumers react is what's driving our disruption and growth. And so I'm just excited to see as more and more consumers move online, as infrastructure becomes cheaper and more available, what are the things are we going to take that we think are exactly the same, but they're not exactly the same.
Yeah, and we've started to see companies go public too. And it was the day that we're recording this, Rosenblatt put out a report on SoFi, which recently went public via a SPAC. And I got a hold of the report, and it says in there, the incumbency legacy banks face a challenging road ahead as a new wave of digitally native and mobile-first banks rush into the market. Challenger banks like SoFi command a powerful cost advantage over incumbents, which will lead to a dramatic disintermediation over the next 5 to 10 years, leaving substantial primary bank accounts, revenues, and market value up for grabs. And that's not just like big banks like JP Morgan and Wells Fargo. Like that's a lot of regional banks is where they're grabbing these customers from as well, depending on which challenger bank you're looking at.
Yeah, definitely. And it's something that's felt all across the value chain, right? Banks, credit unions, their vendors, and so on. And hopefully subprime lenders, check cashers, rent-to-own companies, right? Products that are being used because consumers need them, but can be offered in such a better way if we digitize them and make them better available online at scale.
Is there an area of fintech that you don't think is ripe for more innovation? I mean, I feel like we've seen stuff in everything, but there's just some areas that are, harder than others to truly find a cost advantage or product market fit, things like that.
That's such an interesting question. I think that we are seeing more discussion in the venture funding community about what it means to have a successful company and to build a successful company, and how much time it takes and how complex that is, and kind of what should we be investing in. And I think that, not to take away from powerhouses like the new banks that you're looking at, right? These are types of businesses where they found the thing that works for consumers, and now it's about raising a lot of money and deploying it effectively to grow quickly. That's an awesome thing. That's one type of disruption. I think there's a different type of disruption where if we bring in experienced teams that are willing to work hard and build the unicorn or the decacorn or whatever over a longer period of time, there are a lot more areas that are ripe for disruption, but that disruption is a little bit different than what we've been seeing. It's a slower burn. It is understanding the industry very deeply. It is taking time to create relationships and pivoting as needed to find the right solutions. When I look at companies like Propel that's doing fresh EBT, right? Trying to solve these issues. When I look at companies like Do Not Pay, trying to work on automating a lot of painful processes for people. When I look at companies like Tally that's trying to rethink debt consolidation, just 3 examples off the top of my head of companies that they may not turn into unicorns 2 years in, but they are disrupting something very important. And if they stick to it, they will build tremendously valuable businesses. So when you talk about disruption, the question is what type of disruption? But yeah, I think there's a lot more, in fact, that we can do.
Yeah, and something else that is timely is Andreessen Horowitz just launched their new sort of like blog thing where it's
Right.
talking about technology a lot in the future. And there was one post on there that says technology saves the world. And it can, but there's also this argument where technology, there's a lot of bad things that can come of it too, like we've seen with social media. Are there areas of fintech where you've seen bad things come about, or are there areas where, you know, you just hope companies are a bit more careful than they might be currently?
Yeah, I think that we talked about this a lot in your FinTech Today community, and I think that when we started to record, people asked me, why are you building a third-party collection agency and not building a technology company that sells to collection agencies? And my answer was, if I want to solve the problem, and the problem is the entrenched paradigm of how you talk to consumers about their debt, I have to displace the daily activity. Like I have to manage the person on the phone, in our case, when consumers call in, right? Because almost all of our interactions are automated. I have to manage that. I have to manage their compensation model, because if I don't, I will not drive the change that I want to drive. So just selling a way to email consumers at scale with a notice that goes from like completely Kafkaesque but completely legal to abusive, depending on which collection agency you look at, that's not helpful disruption. So number one, if you're building tools that enable problematic behaviors, that's an issue. If you are just taking something, a problematic product, and you take it online, you're not making a difference, right? And so that is one thing. For example, a concern that I would have around rent-to-own models, right? They could be very problematic if you don't think about them the right way. The other thing is unintended consequences, right? Is free trading good for consumers? Generally, probably. Does it have side effects that could be very negative? Absolutely. And you know, we're not going to talk about the ethics of fintech and so on right now, but people are waking up more and more to that and thinking about what impact do my actions have in the world beyond making me money. I think that's very healthy.
Totally. So on that front, what can people, both the companies that you work with, as well as the consumers that you guys interact with, expect from TrueAccord in the next 6 months and beyond? Any sort of changes that you guys, people should be on the look for?
Well, I don't know if we're teasing some of the things that we're going to be launching later this year, but I can tell you that continuing on the e-commerce paradigm of how to talk to people about their financial lives, financial fitness, and so on, consumers need help beyond the individual debt that's placed on our debt collection subsidiaries system that they may or may not pay. And consumers come to us and say, I love this experience so much. Can I use it for everything else in my life? And it turns out that there's beyond sending digital messages and offering great user experience and having great NPS and better results and so on, there's an impact to brand in the consumer debt space that we have not appreciated as much before we started asking consumers. And it turns out that when consumers like you, they're more likely to pay you first when they have money and can afford to pay. So I would say we're spending a lot of time around that. What does it mean to have a brand with consumers who are in debt? What does it mean to help people at scale beyond the individual debts that we have on our system? And we're in deep conversations with some of our largest clients and partners on what does it mean to really think about a holistic solution there. So that's something that I'm exceptionally excited about in the next few months.
Thank you, Ohad. It was a pleasure being with you today.
Thanks, Julie.